VAT was first introduced in France in 1954 on an extensive scale. Development of VAT in other countries has been gradual. The total number of countries who have adopted VAT as a major form of consumption tax is now more than 141. VAT is a multi-point sales tax which set off for tax paid on purchases. It is collected in installments at each transaction stage in the production distribution process. It does not have cascading effect due to the system of deduction or credit mechanism. VAT is a tax on consumption. The final and total burden of tax is fully and exclusively borne by the domestic consumer of goods and services. Since it is a tax on domestic consumption, no VAT is charged on goods exported. It is an alternative mechanism of collection of tax. In many respects, it is equivalent to a last point retail sales tax. VAT is therefore a multi-stage sales tax levied on value addition.
After studying this module, you will be able to know what is VAT, understand as to how VAT is different from GST, know different methods and variants of VAT, analyze the type of VAT adopted in India, know the type of taxes subsumed under CGST and SGST when GST is implemented. VAT is a multi-point sales tax with set-off for tax paid on purchases. It is collected in installments at each transaction stage in the production distribution process. It does not have cascading effect due to the system of deduction or credit mechanism. VAT is a tax on consumption. The final and total burden of the tax is fully and exclusively borne by the domestic consumer of goods and services. Since it is a tax on domestic consumption, no VAT is charged on goods exported. It is an alternative mechanism of collection of tax in many respects. It is equivalent to a last point retail sales tax. Let us now take an example to understand VAT. Let us assume dealer A to be a raw material producer, B to be a manufacturer, C to be a wholesaler, and D to be a retailer. Dealer A sells his produce at Rs 100 and pays tax at the rate of 12%. As dealer A is a producer of primary product, his tax on inputs is zero. The sale price of Rs 100 plus tax would be the purchase price for dealer B, who is a manufacturer. This dealer will incur certain costs in the form of wages, salaries, other manufacturing expenses, and to all this he would add interest and his own profit. Assume that after adding all these costs, his sale price is Rs 200. On this sale price, the gross tax at the rate of 12% would be Rs 24. As dealer B buys tax paid goods from dealer A, he would get credit for this tax. Therefore, his net VAT viability would be Rs 12 only. Similarly, the sale price for dealer C would be Rs 300. As he buys tax paid goods, his net VAT viability is Rs 12, and the sale price of dealer D would be Rs 400, and his net VAT viability will be Rs 12. This indicates that VAT is collected at each stage of the production and distribution process. The burden of VAT payment falls on final consumers only. Thus, it is a broad-based tax covering the value added of each commodity in a firm during all stages of production and distribution. Now we will discuss variants of VAT. 1. Gross product variant. This variant allows deductions for all purchases of raw materials and components, but no deduction is allowed for business inputs. That is, capital expenditure and depreciation on the plant and machinery is not deductible. 2. Income variant. In this variant of VAT, deductions are allowed for purchases of raw materials and components, as well as depreciation on capital goods. 3. Consumption variant. This variant allows deduction for all business purchases including capital assets, that is, capital expenditure is also deducted from the value addition. This form is neutral between different methods of production, that is, capital intensive or labor intensive. VAT can be computed by three different methods. These are 1. Addition method. This method is based on the value addition at each stage of transaction, which can be estimated by summation of all the elements of value added, that is, wages, profits, rent, and interest. 2. Subtraction method. The subtraction method estimates value added by means of the difference between the value of outputs and inputs. Total tax liability would be equivalent to taxes on output minus taxes on inputs. 3. Tax credit method. Total tax liability would be the difference between gross tax liability and taxes paid on purchase of inputs. To take tax credit, the dealer has the proof of tax paid on inputs in the form of invoice.
The invoice method is widely used in most VAT countries because it makes cross checking of tax paid at earlier stages easier, as dealers are required to mention the amount of tax on invoices. Also, dealers at intermediate stage do not have any incentive to seek special treatment in tax rate. And finally, it facilitates border tax adjustments. If exports are zero rated, the term zero rating in VAT literature refers to not levying tax at the final stage of a transaction and giving refund for the tax that has gone into the commodity at earlier stage. India has been rather slow in the adoption of VAT due to its federal structure. While the union government has the authority to impose a broad spectrum excise duties on production, manufacture, the states are assigned the power to levy sales tax on consumption. In addition, states are empowered to levy some taxes on commodities and services, that is, state excise duty, entertainment tax, electricity duty, motor vehicles tax, passengers and goods tax and octroi. Initially, union excise duty, that is UED, was levied on few select commodities. Gradually, the base and the coverage was increased, and by 1974-75, 124 groups of commodities were covered under UED. Slowly, all commodities except those under the state list were brought under the purview of union excise duty. Since 1986, efforts have been made to reform commodity taxes and the introduction of mod VAT. This was done on the basis of the recommendations of Jha Committee. Mod VAT scheme allowed rebate on tax paid on purchase of inputs. A major breakthrough was recommended by the Reforms Committee called TRC. In 1992, on the basis of that, a central VAT up to the
States are empowered to levy some taxes on commodities and services, viz. State excise duty, entertainment tax, electricity duty, motor vehicles tax, passengers and goods tax, Most of the states have levied sales tax at the first point of sale, that is, levied on first transaction in the production distribution process. The existing state VAT rate structure 2013-14 has a standard rate of VAT that is 13.5% on all the goods except those that are enumerated in any of the lists. Due to the dichotomy in allocation of tax powers between the union and states, India has opted for dual VAT, central VAT at the federal level and state VAT at the state level.
At the states level, sales tax has been in vogue for over 60 years. Most of the states have levied sales tax at the first point of sale, that is, levied on first transaction in the production distribution process. For example, sale by manufacturer to wholesaler. In recent years, efforts have been made to replace sales tax by a state value added tax, that is state VAT. The coverage of tax includes sale of all goods except diesel, petrol, gasoline, aviation turbine fuel, natural gas and liquor. The existing state VAT rate structure 2013-14 has a standard rate of VAT that is 13.5% on all goods except those enumerated in any of the lists. In addition to the standard rate, there are three rate categories, that is 1%, 5% and 20% or more. Interstate trade is taxed by the central government under the Central Sales Tax Act. This is levied to regulate interstate trade and to ensure an equal tax treatment for commodities entering into interstate trade with those locally produced. Presently, it is levied at a low rate of 2% on interstate sales to registered dealers and a higher rate of 10% on sales to unregistered dealers. The rate is low for the registered dealers as he pays state VAT on his sales with no state VAT is charged on the sales of unregistered dealers. Due to the dichotomy in allocation of tax powers between the union and states, as explained above, India has opted for dual VAT, central VAT, that is cen VAT at the federal level and state VAT at the state level. VAT has been an important tax reform. It has removed the cascading effect through the mechanism of set-offs. That is, it does not increase the price of the commodity more than the amount of tax. Also, due to the credit mechanism, this tax has reduced transaction costs for the dealers. It has, in addition, provided the business community an opportunity to improve its operations and to gain a competitive advantage in global economy. The cen VAT was discussed in union excise duty in the previous module in detail, and state VAT would be analyzed in successive modules.
Let us now discuss different weaknesses of VAT. The central VAT is levied on goods manufactured or produced. Taxation only up to the manufacturing level provides a narrow base due to which the tax system lacks neutrality and continues to be inefficient. Services are taxed only by the central government. The states are precluded from taxing services. This has made the structure of tax base very complex. Cascading of tax occurs under both the center and the state taxes. The effective tax rate varies from product to product even if the statutory rate is uniform, making Indian manufacturers comparatively disadvantageous in the international market. The tax administration at both the center and the state levels remains complicated. At the state level, it continues more or less the same way as it was under sales tax regime. After recognizing the weaknesses of the existing dual VAT, it is now proposed to introduce GST to replace the existing dual VAT, service tax, and some other commodity taxes levied by both the center and state governments. With the view to paving the way for the introduction of GST, the Empowered Committee of State Finance Ministers appointed a joint working group on GST. The EC recommended that the CGST should subsume all the indirect taxes on supply of goods and services. These are central VAT, central excise duties, and the additional excise duties levied on pan masala, petroleum, and tobacco products, and those levied under additional duties of excise, Goods of Special Importance Act 1957, additional customs duty in the nature of countervailing duty, and other domestic taxes imposed on imports, cesses levied by the Union, surcharges levied by the Union, service tax. In regard to the state GST, the EC suggested that these taxes would be subsumed at state level, viz., state VAT sales tax, entertainment tax, luxury tax, taxes on lottery, betting and gambling, and entry tax not in lieu of cesses and surcharges. According to EC, the alcoholic beverages should be kept out of GST.
In regard to the state GST, the EC suggested that the following taxes would be subsumed at state level. For example, state VAT, sales tax, entertainment tax, luxury tax, taxes on lottery, betting and gambling, and entry tax not in lieu of octroi and cesses and surcharges. According to EC, the alcoholic beverages should be kept out of GST. With the above central and state taxes being subsumed under GST, the proposed GST will have two components: central GST levied by the center and state GST levied by the states. In the proposed scheme of GST, the base of the central GST and state GST would be the same. That is, the base of the current CENVAT would be extended from the manufacturing to the retail level. The GST would be levied on all goods and services with a few exceptions. The notable exceptions under the CGST include those granted to small scale industries and units under the backward area schemes. The exemptions from the service tax should also be unified and the tax be made a general tax rather than a selective tax. On the same lines, under state VAT, also all exempted goods need to be brought under the tax net. With the proposed GST having two components, that is central GST and state GST, the rates of the two components will be prescribed separately, keeping in view the revenue consideration, total tax burden and the acceptability of the tax.
Main issues under GST relates to coverage and base of tax, rate of tax, taxation of interstate trade, and administration of tax, the combined tax rate on a commodity is 23.5%, state VAT 13.5%, and Sen VAT 10%, and this has to be reduced in the range of 15 to 16%. In the scheme of GST, it is proposed that the base of the two components of the GST should be the same. In doing so, it calls for major changes in the tax system of the center and the states. In regard to the central taxes, the scheme proposes an extension in the base of Sen VAT from the manufacturing to the retail level. This change in the CGST will provide additional yield to the government. For states, the tax revenue will also increase as service tax would be assigned simultaneously to them except the goods under negative list. Given the present rate of 10% on goods with some variations and 10% on services under Sen VAT and 13.5% with other rate categories of 4% and 20% under state VAT, the GST revenue neutral rate would work out to be around 20%. The Kelkar task force has also recommended such a rate for GST. It is suggested that the proposed rate of GST should preferably be in the vicinity of 15 to 16%. The proposed low rate of GST should be levied on all goods and services with a few exceptions. As of now, the notable exemptions under the Sen GST include those granted to small scale industries and units under the backward area schemes. On the same lines, under state VAT, also all exempted goods need to be brought under the tax net. This will ensure an effective GST.
It is, however, felt that the high rate of GST at the retail level will pose problems in the administration of the tax. It is suggested that the proposed rate of GST should preferably be in the vicinity of 15% to 16%. This could be accomplished by readjusting the basis of both the components of GST, given the fact that approximately 40% of the revenue of Sen VAT and state VAT, that is accruing from petroleum products, is not under VAT, and also proposed that it should not be under GST. The proposed low rate of GST should be levied on all goods and services with a few exceptions. As of now, the notable exceptions under the Sen GST include those granted to small scale industries and units under the backward area schemes. On the same lines, under state VAT, also all exempted goods need to be brought under the tax net. In doing so, there is a politico-economic argument to leave out essential commodities like food, medicines, clothing, etc. from the tax base. However, such exemptions benefit upper income families more because of their larger spending power. Hence, all these items must be brought under tax net, and the government should provide direct subsidy to the poor consumers. A low rate will ensure an effective GST. Over a period of time, it is learned that the states and the center are probably reaching to a consensus to have 16% rate, 8% for each tier of government.
Tax on interstate trade under the current system of dual VAT is origin based and is collected by the exporting state under the provisions of the Central Sales Tax Act. The CST being inconsistent with the GST as a precursor to GST, the center and states had agreed in 2007 to phase out CST over a period of 3 years, by which time it was planned to have GST in place but the states lose considerable revenue with reduction in CST rates. With the introduction of GST, the current system of CST would be replaced by a destination based integrated GST IGST. There would be no tax exporting under IGST, thus, exports would be zero rated.
With the introduction of GST, the current system of CST would be replaced by a destination based integrated GST called IGST. There would be no tax exporting under IGST. All taxes levied on the transaction preceding interstate transaction would get set off. All inputs including capital goods would be given set off. Thus, exports would be zero rated. In view of the fact that under the present provisions of the Constitution, the centre is not empowered to levy tax beyond manufacturer and the states cannot levy taxes on services. Amendment in the Constitution is a prerequisite to levy GST. In view of this, constitutional amendments to empower both the centre and the states to levy the proposed tax, the Finance Minister had tabled the Constitution Amendment Bill in the Parliament on 20th March 2011 and the Union Cabinet has cleared the bill.
The Finance Minister had tabled the Constitution Amendment Bill in the Parliament to empower both the centre and states to levy the GST. However, the states have some serious objections on the provisions of the bill. 1. Objection regarding the setting up of a GST Council to make recommendations on issues like rates of tax, exemptions, and threshold limits. 2. The bill provides for the setting up of a GST Dispute Settlement Authority. The states have serious concern about the need of having such a body. The central government wants that the petroleum products should be included under GST to have a broader base for the tax, but the states want this to be excluded from the GST.
With the introduction of GST, the current system of CST would be replaced by a destination based integrated GST called IGST. There would be no tax exporting under IGST. All taxes levied on the transaction preceding interstate transaction would get set off. All inputs including capital goods would be given set off. Thus, exports would be zero rated. In view of the fact that under the present provisions of the Constitution, the centre is not empowered to levy tax beyond manufacturer and the states cannot levy taxes on services. Amendment in the Constitution is a prerequisite to levy GST. In view of this, constitutional amendments to empower both the centre and the states to levy the proposed tax, the Finance Minister had tabled the Constitution Amendment Bill in the Parliament on 20th March 2011 and the Union Cabinet has cleared the bill. Thus, the introduction of GST would have an efficient, effective and taxpayer friendly system of taxation of goods and services in line with the best international practices. The proposed GST will have two components: central GST levied by the centre and the state GST levied by the states. In the proposed scheme of GST, the base of the central GST and the state GST would be the same. That is, the base of the current cent VAT would be extended from the manufacturing to the retail level. Also, with the introduction of GST, the current system of central sales tax, that is CST, would be replaced by an integrated GST, that is IGST, which would be destination based. Therefore, there would be no tax exporting to the importing states. All inputs, including capital goods, would be given set off. Also, export would be zero rated. Let us now recapitulate what we have studied in this module. VAT is a multi-point sales tax with set off for tax paid on purchases. It is collected in installments at each transaction stage in the production distribution system. The burden of VAT payments fall on final consumers only. VAT could be levied with three specific variants. For example, gross product variant, income type variant and consumption type variant. Gross product variant allows deduction for all purchases of raw materials and components, but no deduction is allowed for business inputs, that is capital expenditure and depreciation on the plant and machinery. Income variant allows deduction for purchases of non-capital inputs and depreciation on capital goods. Consumption variant allows deduction for all business purchases including capital assets. VAT can be computed by three different methods. These are addition method, subtraction method and tax credit method. In India, a system of dual VAT exists. Central VAT, that is cent VAT, at the federal level up to the manufacturing level and state VAT at the state level. GST is a tax levied on goods and services with the credit for tax paid on inputs both for goods and services. Like VAT, GST will also have two counterparts, that is cent GST levied by center and state GST levied by the state. CGST should subsume taxes on goods and services such as union excise duty and the additional excise duties, additional customs duty in the nature of CVD and other domestic taxes imposed, cesses and surcharges and service tax. State GST would be subsuming, for example, state tax, state VAT, sales tax, entertainment tax, luxury tax, taxes on lottery, betting and gambling and entry tax not in lieu of octroi and cesses and surcharges. The base of two components of GST, that is the central GST and the state GST, would be the same. The base of current cent VAT would be extended from the manufacturing to the retail level. With the introduction of GST, current system of central sales tax CST would be replaced by an integrated GST, that is IGST, which would be destination based. Exemptions under the CGST granted to small scale industries and units under the backward area schemes. in view of the fact that under the present provision of the Constitution, the Centre is not empowered to levy tax beyond manufacture and the states cannot levy taxes on services. Thus, Constitution amendment is a prerequisite to levy GST. In view of this, constitutional amendments to empower both the centre and the states to levy the proposed tax, the Finance Minister had tabled the Constitution Amendment Bill in the Parliament on 20th March 2011. However, the states have some serious objections on the provision of the bill. First objection is regarding the setting up of a GST Council to make recommendations on issues like rates of tax, exemptions and threshold limits. Second objection related to the need for the setting up of GST Dispute Settlement Authority as proposed in the bill. Third, objection related to the petroleum products in the coverage of GST. The Management Information System is also an integrated part of the SGST and CGST system. The integration of information for SGST, CGST, customs and income tax through PAN number and tax information exchange system called TIN-XSYS would be an essential component of GST administration.